Okay, we are ready to go. Dana, please count to 5 and you can start.
All right, hello everyone. My name is Dana and I am co-director at Kickstart Global, the largest student-run cross-campus accelerator program in the UK. Today we have a really exciting panel discussion on early stage seed investment within the CEE ecosystem, as well as internationally. As part of the panel, we have Olivia Exton, who is program manager at Startup Campus, Tomasz Mazurik, who is managing partner at Funding Box Deep Tech Fund, as well as Oscar Ramos, who is managing director and partner at China Accelerator. Throughout the panel, if you have any questions, leave them in the chat box and we'll try to get to it. All right, let's start with some speaker introductions. Speakers, let the audience know, who are you and what does your organization do? If we start with Olivia, and then let's go on to Tomasz, and let's go on to Oscar.
Hi, Dana, and thank you very much. The good old ladies first. So, hi everyone, my name is Olivia Exton, and I'm the program manager of Startup Campus London. A bit about Startup Campus. So, originally, many years ago, well, roughly five, six, we started off as an educational program for companies, early stage companies at universities. And then we developed into an incubator, and we also invest in Hungary. And as we were working together with companies, we saw that one of the biggest issues that when they face is during the international expansion, because they don't really know the answers to the question of when, how, and where. So this is when we opened an office in Berlin and also in London, and now we are working also as an international accelerator. So as I said, we invest in Hungary, but internationally we basically support companies in international expansion, which also includes raising cross-regional investment. But now let's go to the next speaker.
Thank you. Tomasz Mazurik, I'm managing partner of Funding Box Deep Tech Fund. We are a seed fund investing between 100,000 euros and 1 million euros in technological companies across Europe. We are looking for companies having some technological advantage. So some secret sauce, some protected IP that can help them outcompete their competitors. Funding Box Deep Tech Fund is part of the larger ecosystem, Funding Box Group, that is helping startups and SMEs across Europe to scale, to grow, and to deploy digital technologies in their daily business. So Funding Box Group is active on the market since 2012, and since then we have supported 200 startups and 200 SMEs on their growth path. So next to the next speaker, Oscar.
Thank you, Thomas, Olivia, and Dana, and great to have an opportunity as a European. It's great to have an opportunity to connect with your European ecosystem far away from Asia. So I'm Oscar Ramos. I'm Spanish by birth, but now for over a decade in China, where as a partner of SOSV, I'm investing in early stage companies. So SOSV is a global VC fund, originally headquartered in the US. We have almost $1 billion under management, and last year we were the most active early and seed stage investors in the world. We have over 1,100 portfolio companies that we invested, and there's a few things that makes us unique as investors. The first thing is that we're sector agnostic. We have no specific industry focus, although we like to invest in companies that will make the world a better place, with our definition of the world a better place. And we are actually geographically agnostic, so we invest literally everywhere, and we have actually no problem to make direct investments into jurisdictions that traditionally some investors have felt a bit uncomfortable. So as long as you are based in a region that is part of the World Trade Organization, we are happy to invest directly in your company. So we make quite a few investments in Europe, US, and of course in Asia, where I'm based. Third thing is that as a VC, early stage VC, we believe that early stage investment is necessary for funders. They do need capital access, but sometimes the additional support that is provided to these funders can make a bigger difference. And to be able to scale that support and be able to work with almost 200 companies every year, what we do is we structure our support through accelerators. That's where our specialization come into place. We have three main verticals on hardware, where Hacks is our hardware investment arm, first hardware accelerator in the world, and made us the most active hardware investor in the world. IndieBio is our biotech, synthetic biology, life sciences accelerator, working with wet labs and companies that also made us most active investor in biotech in the world. And then finally, on the software ecosystem, we have two accelerators. One is more focused on consumer internet companies with a stronger focus in mobile first, mobile only regions, Asia, Eastern Europe, Latin America, and increasingly looking into Africa as an area of investment. And then finally, the one that I'm managing director, based in Shanghai, obviously working a lot with the Chinese market, but global by design, where we are looking into B2B and enterprise companies. The reason why we're based in Shanghai is not just because we're investing in this market that is very interesting, is because as the economy evolves and China becomes one of the growth engines for the global economy, companies in this part of the world, they face a lot of competition. And that competition forces them to innovate or disappear. The local players are getting better. Everybody wants to come to China. And companies here have to innovate. They need to become more productive and efficient. That has made the whole process of B2B and enterprise innovation way shorter, something that was in the past always very difficult for other companies. And what is becoming more interesting, and has been accelerated with COVID, is that as China was hit by COVID first, and they were forced to use all their innovation power and fast prototyping skills to build new solutions, the rest of the world realized that the Chinese innovation also has global applications. So we see more and more companies that are discovering solutions in China that then they are bringing to other parts of the world. So for entrepreneurs that are building global companies, and they realize that smart money, capital, network can make a big difference, we are here to help scale. So happy to have this conversation today and be able to join amazing speakers in this debate.
Thank you so much for the speakers for that introduction, as well as a quick intro into the topic of today's panel. We have a very international speaker panel here, and we can't discuss about early stage seed investment without touching on the fact that there has been so much happening these few years, with COVID currently happening, with Brexit happening. And to start off the panel and to explore, in terms of your ecosystem, what is currently happening? What are some positive and negative trends that you've seen that are driving this ecosystem? Just paint us a picture of what your ecosystem is currently like within the early stage seed investment team. Happy for whichever speaker to take this up.
All right, I might start. Well, in our assessment, the COVID situation has caused that the world is getting even smaller, because suddenly it's becoming totally acceptable to people to meet over Zoom. You don't need to travel. There are more and more small local events, like demo days of local accelerators, that you can suddenly just jump in, have a look at interesting startups and explore those distant parts of the worldwide ecosystem that in normal situation you would not be able to. So we find this trend very, very interesting, and we are exploring this, jumping into different places and looking for interesting startups. So for us, as a Funding Box Deep Tech Fund, the change that was started by COVID is meaning, in practical terms, much easier access to more distributed deal flows across different local ecosystems. So let me start with this, and over to the next speakers.
I'm unmuted now. Okay. So I would just give a more general overview of the UK ecosystem. So obviously in the UK, besides COVID, we also have Brexit, something that everyone, no one wants to say out, but we have to speak up regarding that as well. So I can give you a few numbers. So in the UK in 2020, there has been a record VC investment has been raised, over 15 billion US dollars. Also, just London itself has raised more VC investment than Paris, Berlin, Stockholm, and Tel Aviv together. And also, despite Brexit, 68% of investors, VC investment came from foreign investors in the UK. So yes, obviously Brexit and obviously COVID as well has impact on the ecosystem itself. But as you can see right now, the ecosystem is actually doing pretty well, and we will see the actual impact of COVID and Brexit later on. So that's what I could add to this one. Oscar, the floor is yours.
So, I mean, the numbers that Olivia just shared are actually a fact. Like globally, last year was a record year for VC globally. But if you look at the data and you analyze a bit more on the seed stage, actually the number of transactions happened, and the average volume of those transactions was actually slightly higher, which basically meant there were less companies funded, and the ones that were funded, they were able to raise a bit more money than average, which obviously had a very important impact in the companies. What we saw last year, for us, last year was a record year. We had a great year from the point of view of a number of investments that we made, follow-on funding raised by our companies, and also revenue. I mean, we in terms of investing in companies, we're very driven by making sure the companies build real businesses. Last year was a great year for startups in terms of opportunities. Every crisis, every change opens space for new players. There were so many things that needed to be changed, so many things that the status quo was simply not okay, that the startups were able to play in a space where they actually perform the best. Startups are really strong at playing when there's uncertainty and there's no clarity. And I mean, obviously, last year everything was turned upside down. Startups tend to be the disruptors. They tend to be the ones that drive the disruption to other industries. And what happened last year was that the disruption is exactly what driven the startups. The startups were basically trying to find solutions by everything that was impacted. That being said, the situation was very different for us. My ecosystem is very global. Last year, made investments in Europe, in America, in different parts of Asia, in Australia, and we can see very different behaviors in different parts of the world. We also saw very different behaviors depending on the industry. So obviously, travel was extremely impacted. Like travel companies, they really got into trouble. They were not able to survive in some cases, or they had to pivot and change the business model to something absolutely different. But there were also areas and industries that they were really benefiting from that. We see logistics, we see healthcare and online education having a lot of push in terms of their progress during last year.
That's definitely really interesting, and it's really interesting that you pointed out that there are less transactions for larger checks and that different industries have been impacted differently. I wanted to ask Tomasz, have you seen the same within the CEE ecosystem?
Yeah, definitely. So the COVID time was the part of was the time where there was a bit uncertainty. There was a moment where everything has stopped for a while, but specifically the startup ecosystem was the first one to recover. As Oscar has said, startups are used to perform in uncertain times, in uncertain environment, and many of them are working on the new technologies. So the new technologies were the least impacted and were the, let's say, the biggest hope for the change, not like a classical business like restaurants or the hotels that were most impacted. So I think this short period of uncertainty was something that obviously was there because everybody wanted to look around what's happening, but then it has recovered pretty quickly. Here in CE, specifically in Poland, we had also the record year in terms of investment into the Polish companies. I don't have now the statistics about the overall CE, but I guess it could have been similar. So yeah, I fully agree with the statement of Oscar.
I think I would just jump in and just add so much to the whole discussion that it's also very nice to see that from companies and more and corporates as well in general, they had to digitalize. So there was no like maybe or later, they had to do it. So I think it in general overall for the ecosystem and for the market itself, it did have for long term a good impact. Also like a very like it's changed like for not just for now, but I think like for a good while. But that was also nice to see, and obviously a reason why companies were now startups were finally able to have meetings that they were waiting for a long time, and they were always delayed. But this time it was like the companies were open to have them with the startups.
I think that something that is very interesting, building on something that Thomas said. The world became smaller, and as everybody started to realize that you can do work over like conferences, and there's no need to have sometimes physical meetings. Naturally, just based on the fact that you don't have to synchronize so many agendas, or the synchronization of agendas becomes easier because you can skip the commute time or logistics or having to move people around. Everybody became also a bit more flexible in terms of schedules to be able to accommodate calls where including parties from different parts of the world. That definitely was a massive benefit for companies in smaller ecosystems. So larger ecosystems, they have a larger natural market in where they are, and they also have more access to capital. That capital in some cases is necessary because also the cost of operation in those markets are smaller. But companies that were in smaller ecosystems, they were able to operate with a lower burn rate, lower runway, and lower expenses and cost of operation. And once they are able to accelerate and increase the access to customers all over the world, that created a very, very interesting dynamic that made everything way faster. I think that's something that hopefully would have changed the perception in terms of localization of potential clients.
Definitely. I mean, because of COVID, all four of us are able to gather together virtually. All of us are in different countries, and then Oscar is in a completely different time zone. And because of COVID and digitalization, we are able to gather together here. And the highlights of today's panel is definitely kind of the Stairway to Heaven or Road to Hell. I want to explore that more in depth. Based on your experiences, what are some best practices that investors can do to help startups put them on the Stairway to Heaven? And equally, what are some pitfalls that you've seen that people have done that can bring startups on the road to hell within this early stage investment journey?
I'm happy to start. I would compare startups with kids. You know, at the earliest stage of their development, it is important to make the right steps. So when you send the kid to the kindergarten or to primary school, it is important to make the right decisions, but also as the parents need to make the proper decisions by themselves, how to support their kids. And I think it's very relevant comparison with startups because the seed investor, the first investor in the company, is having a very important influence on this, how the startup is going to develop. And that's why it is very important also to choose the right investor on the startup side. Because, as you have Dana said, it can be either Stairway to Heaven or Road to Hell if the wrong decisions are made at the very beginning. One of the examples of bad decisions at the very beginning is the broken cap table. When we are looking at startups as the potential investment targets, and there is an investor already, that's the most common wrong things that was done in the previous stages. And either we are able to fix it through the negotiations, or if the cap table is broken, we simply have to skip the deal, because it doesn't have any perspective to have further rounds. And this is the most extreme case, the broken cap table. But obviously, we also observe some investors that at the very beginning they are just, spraying and praying, meaning not supporting their startups. So this is not that bad as the broken cap table, but still we believe that every investor onboarding to the startup should have on his agenda the way and the idea how he could support the startup, not only just put the money, close his eyes, and then call startup again in 5 years and asking where is my money, because that's not what is it about.
Yeah, I do agree. I think besides investment, obviously, it's very important to provide the right connections, the right advice, and also training for the companies and the founders. But in general, two things that I would highlight that I've seen quite often is as an advice what an investor could say is finding the right co-founder. I think that's key at the very early stage. But also to realize that when you are starting a company, you're all departments. You have to do everything from the accounting to the sales to the marketing to building the product, and et cetera, et cetera. So what is very important is to realize what are your weaknesses very early on and start hiring them once you have the money for it and the capacity. So start hiring your weaknesses and focus on things that you are good at, because otherwise you're going to lose a lot of time and money. So no one wants that. And the other thing is have an open mind and listen to the feedback, because what I very often see is that founders, they are so rigidly still thinking that whatever the original idea was, it should work, because for whatever reason they think this. And I think it's very important that when your investor says a feedback or your customers are saying a feedback, listen to them and don't listen to everything. Obviously, think about it, but may be able to pivot, to change, etc., etc. To give you also an example, YouTube started off as a dating website, right? So, and now it's slightly different. So this is one of the things that I would say. But in terms of from the other side, and I'm enough a bit, but I have also seen that very often investors, obviously they have a lot of companies that they have to look after, and they go to many meetings unprepared. So they listen to whatever the startup has to say, and then they just throw in a question or throw in a comment without thinking what is this going to trigger in the mind of the founders. And then the founders go away and they start developing something or start changing things that actually the investor was not actually suggesting, but they just threw in some kind of a comment or question and then derailed hopefully, but they derailed the company from its original track in not the right direction. So I think that's also a negativity. But also the other thing that I would highlight is what could be straight to hell is by taking too long and I've seen a lot of companies stressing way too much and losing way too much time on raising the next round, not necessarily because it's their own fault, or often not getting the money on time. So and running out of actually cash. So these are the things that I would highlight. But now, Oscar, I hand over the mic to you.
Yeah, you covered a lot of the mistakes already, so I'm not sure there's anything for me to add more. Well, I'll say that for me, in my opinion, one of the reasons why seed capital can very easily be the direct path to hell is confusing seed capital with validation. Confusing and assuming that because you raise money, you actually are in the right path. And that validation is actually something that confirms that what you're doing is okay. For us, this is something that we tell every single startup that we invest when we take them through our process of acceleration. We tell them all that we have not invested in what they're doing right now. In some cases, we clarify that we might have invested in spite of what they're doing right now, and that most likely we expect them to change. And we expect them to change based on our own experience. So far, every single company that we invested that raised a Series A or was able to generate a significant amount of revenue, they've done that with a business model that was different than the one they had when we originally invested. This week, one of our portfolio companies, they announced that they just raised a $100 million round. And the model that company is racing to is running today has basically nothing to do what they used to run when they went through our program 5 years ago. And that process evolution today, at least, is not the exception, is the rule. Every single company that was able to raise any money, they did that. And we are kind of a unique accelerator program because the companies that go through a program, in most cases, they have raised seed capital before us. They come with a relatively interesting level of revenue. We have a company that just started our program 3 weeks ago that is making $250,000 in net revenue on a monthly basis. So companies have a certain level of validation. Well, that company in 3 weeks already realized that their growth expansion could be improved, that their monetization strategy is actually something that they've been stuck. The company is doing okay, but assuming that that seed round is validation that everything that you're doing is in the right way and you don't have to change is something that takes companies to basically die. Because even if your business model is correct, what takes you from 0 to 1 or 1 to 10 might not be what will take you to the next level of your company. And this is painful because, I mean, as a founder, I've been there. As a founder, I've been there fighting to get my company to profitability, being able to achieve something. And once you know something that is comfortable and feels safe, and you are like having a feeling of control, letting go from that and go again to the unknown and try something different, that's very scary. And that's very scary and looks dangerous, and potentially you don't know if that's gonna be going anywhere. So that process of believing that what you've done is validation is what makes a lot of companies eventually not making it and not being able to achieve the potential success. The second thing is that once you raise that capital, there's sometimes situations where founders look at it as, okay, we've done it. Okay, that's the achievement. Actually, raising capital is the beginning of your problems. Okay, we are so VC, we're kind of like relatively interested in terms of our approach of investment because when we invest, we take common equity into the companies. And startups, when they raise money, they have common equity and they have preferred equity. Preferred equity is the equity that investors normally have. Preferred equity tends to have certain types of rights over the common equity that will protect the investor's interest if the company raises additional capital and eventually the exit is not as high as you expected. So normally it is in the interest of entrepreneurs to make sure that they don't have too much preferred equity into the company, or if they do it in the right terms. So it's very important for companies to understand that raising money is the moment where you need to start actually working double, triple, and potentially even harder to make sure that you make all of that, all of the value that you can get from that money. You maximize it as much as you can. So it is not time to relax. It is not time to start overspending. It's time to start thinking, okay, now that I can scale, I need to nail it, and after that, scale it. And potentially, the farther you can get, the less dilution you'll have in your company.
Completely. Thank you so much for the really good pointers. There was a lot of really insightful points there, from investor relationship being a two-way thing, that you have to choose your investor very wisely, as well as for startups, but also what Oscar just mentioned, that getting investment is not the final goal. It's the start of a journey. And I feel like something really interesting that Oscar mentioned is that it is a journey towards scalability. And with such an international panel that we have today, I wanted to quickly explore what are your thoughts, especially the panel speakers' thoughts around international collaboration between different ecosystems to help early stage startups grow and expand into global markets?
I think I would jump in and answer this question first. So, especially because I'm working on a lot of programs that are focusing on this. One of them is called Discover Europe. And the reason why we started this program is because my colleague and I, we've been traveling quite a lot in Southeast Asia. And we saw that there's interest from all different kind of levels of companies to discover Europe, but it's just too fragmented. And I think very often the issue that companies are facing it is that the horizon in a way is not wide enough. So I think it's very important to join as many programs as you can, especially now that everything is digital and you can just travel across the world in one day online. So meet as many people as you can, join as many programs as you can, and learn as much about different kind of ecosystems, business cultures, and marketplaces, and different industries and sectors in different regions. To basically have as much information and impact from these kind of experiences as you can get. So I think that's key, and it's also very important from the accelerator and investor side to support these kind of initiatives, but also from the government side, because obviously, for an early stage company, the numbers are not going to be cracking down there if they join a program like this. So I think this is a very complex question with a very complex answer, but it's definitely something that it's much easier to do now because everything is digital, but it's something that it's great and we should continue doing.
The seed investment is usually happening at the very local stage, right? In the local ecosystem. That's the first investor that jumps into the company. But as we have commented, those are the next steps to be done, next steps of the stairway. So when the company starts growing, I think it's getting more relevant that it gets connected and immersed in more ecosystems, because once the company grows and raises next rounds of money, very often it's raising money from different investors, ideally from different ecosystems. So at the very beginning, we tell to the companies that we are investing in their strength and not in the lack of weaknesses, because the weaknesses you can fix if you see a good team, if you see the good product. But if you've got a company that is not so hot, but doesn't have the major weaknesses, then probably it's not nothing that is going to be extraordinary company. So we are looking for those unique strengths, and then we are helping the companies to cover their weaknesses with additional resources, our network, etc., and with connections to the other ecosystems, so that they can grow globally.
Yeah, this is actually a very, very relevant question for what we do, because when you're investing in so many parts of the world as we do, having this connection with the local ecosystem they are fundamental. So we're kind of like connectors of different ecosystems that create opportunities for collaboration. There's a lot of like startup organizations, entrepreneurial organizations that really facilitate this event, for example. This event right now is having like 4 of us from different parts of the world working in different ecosystems, and hopefully this will create more opportunities for collaboration. This situation that we're living right now, where travel is restricted, is actually making this even more active. Right before this call, I was in a call with people from New York and other parts of Europe, etc. And you're traveling the world very easily in a way that will make more and more collaboration easier. So I think the key is these type of activities will kick off the conversations, will make things happen. But it's all of us that are part of this opportunity, the ones that need to find a way to take it to the next level, the ones that need to be able to build these bridges, and to a certain degree, invite people to join these bridges, invite people to participate, but also sometimes being very aware that internationalization is not for everybody. There's a lot of startups that will waste a lot of time and potentially will have very negative impact for them if they start this international expansion too early. Sometimes you need to work locally where you have more knowledge of the ecosystem, where you can work on an environment that is more known and more controlled, so you can develop things. The situation that we see sometimes is there are companies that are doing the right thing in the wrong place. The early adopters for the technology are not present in their market, or maybe you have the skills to do something, but the regulation in that market is making things very, very difficult. We're talking this morning with the ecosystem of DeFi startups in China, where it's very, very strong, but the regulations locally make it very difficult for these companies to operate in this market. So by design, they need to start the international expansion of their business really fast. Or some deep tech companies that they're able to create amazing technologies. And we've seen a few cases in the healthcare space where, due to the current restrictions, it's very difficult for them to go through these clinical trials. And well, I mean, in China, we're very open, and clinical trials can be run. So I think there's there's definitely great opportunities there, but those that are potential gatekeepers and gate openers need to also be able to at least create the awareness on those that are coming, that it could be heaven or it could be hell.
Excellent points from everyone. As we wrap up, kind of draw close to the end of the panel, and we've explored so many different topics, from existing trends, best practices, as well as international collaboration. I wanted to just quickly ask, seed investment, do you feel like it's a stairway to the heaven or a road to hell?
I would say it depends. I would have an advice to all startup founders: choose your investor wisely, and this is going to have the largest impact on this if it's the road to hell or stairway to heaven. So my recommendation would be that all founders get the Venture Deals book by Brad Feld and Jason Mendelsohn. It's a kind of a Bible in this world. The subtitle of this book is "Be Smarter than Your Lawyer and Venture Capitalist." So this is not a book for the venture capitalists. This is the book for the startups, so they can understand what it takes to get an investment, what are the consequences of every step they take. And I think that's a very good starting point. So go to Amazon, grab your copy of book, read it, and then start talking to investor. And then your chances of getting on a stairway to heaven are getting higher and higher.
All right.
I'll say that that it's going to be. I mean, it's definitely totally in agreement with Thomas. If the only thing you're getting from your seed investor is capital, potentially this is going to be a very difficult road ahead. So the same way that investors will pick startups, founders need to pick investors, and that involves a self-awareness exercise of realizing what is blocking my growth, what is preventing me from taking the company to the next level, and then having that honest conversation with this investor to have alignment in terms of what do we need to do together to be able to help the company move forward. So it is going to be your decision in terms of the alignment, and also in terms of how do you think about that moment.
For me, the line is working a bit. So I don't know if you can hear me or not. But yeah, okay, good. Because everyone else is frozen, so the perks of online conferences. But yeah, so basically what I would say is I do agree with everything that has been said already. But I think in order to make seed investment a road to heaven, I would say it's very important that the companies and the founders themselves, they have a stake and things like that as well, because very often I see that, unfortunately, founders say that, oh well, I would just work as long as the money keep on coming, and if I lose it, so what? I didn't lose anything else except just the investment, but from their own side, they didn't have to put much in. So I think it's important for everyone that it's not just investors giving money and that's it, but also that the founders themselves, they have a stake in the whole company and the investment as well. So.
All right. I think that marks the end of the panel discussion. Thank you so much to the speakers for contributing your really insightful points into the discussion. I personally really enjoyed chatting with you guys, as well as hearing about your thoughts on the various topics that we discussed. And hopefully the audience managed to get some value out of this discussion, and hope you enjoy the rest of the summit.
A pleasure to be here today.
Thank you very much, Dana. It was great. See you guys.